Before you invest a single dollar, there are steps almost no one talks about, and skipping them is the fastest way to lose money. Most people rush into investing without preparing mentally, emotionally, or strategically. They look for opportunities first and foundations later. That's backwards. In Mindset and Money, we focus on what comes before investing, because markets don't punish lack of information, they punish lack of preparation. In this video, we'll walk through the essential steps you must take before investing, how to control your emotions, define your purpose, build discipline, and think long-term. These steps won't make you rich overnight, but they will keep you from making expensive mistakes. If you skip them, the market will teach you with interest. Let's start at the only place that makes sense: your mindset. Chapter 1: Emotional Mastery. Before talking about money, we need to talk about emotions.
Because the greatest enemy of an investor is not the market, not inflation, not competition. It's himself. Seneca warned, "No wind is favorable for the sailor who doesn't know his destination." In investing, emotions are that chaotic wind. Fear, euphoria, anxiety, impatience. Fear makes you sell when you should hold. Euphoria makes you buy when you should wait. Impatience makes you abandon processes that need time. This applies equally to the stock market and to business. An emotional entrepreneur makes poor decisions under pressure or excessive optimism. An emotional investor turns a solid strategy into a disaster. That's why the first task is learning not to react. The Stoics trained this daily. They didn't deny emotions, they observed them without letting them take control. Marcus Aurelius said, "The greatest power is not ruling an empire, but ruling yourself." Investing well requires calm in the middle of noise. Knowing whether to invest in a business that looks fantastic requires observation and analysis. And that calm is not improvised, it is cultivated daily. If you can't control your emotions in everyday life, you won't control them when your money is on the line. We explore this topic in much greater depth in the video linked in the pinned comment.
Chapter 2: Clarity of Purpose and Time Horizon. The second step is knowing why and for what you invest. Many people enter the world of investing without direction. They just want to make money. But that's not a goal, it's a vague desire. Nietzsche said, "He who has a why can endure almost any how." In investing, your why defines your strategy. Are you investing for long-term freedom? For additional income? To build generational wealth? Without clarity, you make the most common mistake: copying strategies that are not meant for you. Time horizon is critical. Investing for 30 years is not the same as investing for 6 months. Those who don't define their horizon end up frustrated, constantly changing strategies and losing money. Patience is not passivity. It is clear direction sustained over time. Chapter 3: Basic Financial Education. Now let's talk about knowledge. Investing without understanding the basics is like driving a manual car without knowing what a clutch is. Adam Smith, the father of modern economics, said, "The most profitable investment is the one made in knowledge." You don't need to be an economist, but you do need to understand fundamental concepts: risk, return, diversification, liquidity, opportunity cost. Without this foundation, you depend on other people's opinions, and those who invest blindly in advice always end up paying the price. An important skill here is understanding what you don't know. Intellectual humility is a competitive advantage. Investing is not about proving you're smart. It's about avoiding unnecessary and painful mistakes. Chapter 4: seed capital, and financial discipline. Now let's talk about real money. Many people want to invest but don't have capital, not because they don't earn enough, but because they lack discipline. Aristotle said virtue is built through habit. In finance, that habit is conscious saving. Seed capital rarely appears overnight. It is built through systematic saving, reducing impulsive spending, prioritizing the future over immediate pleasure. You don't need much to start, but you do need consistency. If you can't manage small amounts of money, you won't manage large ones. That's why many lottery winners end up broke. Seed capital is not just money, it's a proof of self-control.
Chapter 5. Analyzing Investment Opportunities. Now we reach analysis. But be careful. Analyzing is not guessing. Descartes proposed methodical doubt. In investing, that means questioning promises, numbers, and expectations. Even if it's a close friend and the idea sounds amazing, run the numbers first. Every investment must answer basic questions. Do I understand how it makes money? Where is the real risk? What could go wrong? Am I willing to accept it? If you don't understand the business model, don't invest. Unnecessary complexity is a warning sign. Investing is not gambling. It's informed decision-making under uncertainty. Chapter 6. Psychology of Risk and Failure. This is where many people stop, because failure is rarely discussed. But failure is part of the process. Ray Dalio, one of the most successful investors in history, said, "Pain plus reflection equals progress." The problem is not losing. The problem is not learning. Those who fear failure never invest. Those who don't learn from failure repeat it. Successful investing requires accepting that not everything will work, and that outcomes do not define your value as a person. Separating identity from results is essential for long-term survival. Chapter 7. Patience, Consistency, and Time. The final element is time. Time is the investor's most powerful ally, and the most underestimated one. Most people quit too early. Marcus Aurelius reminded us, consistency is the strength of the wise. Investing well is not exciting. It's boring, repetitive, slow, but it works. Those who seek adrenaline lose money. Those who seek consistency build wealth. Investing is not a trick. It's a consequence of mindset, discipline, knowledge, and emotional control. It doesn't sound as exciting as the gurus make it seem, does it? Building wealth is like constructing a skyscraper. If you don't do the cold, boring calculations first, you won't get past the first floor. Before investing money, invest in yourself, because the best asset you can build is yourself. If this approach helped you see investing from a deeper and more realistic perspective, subscribe to Mindset and Money. We don't promise shortcuts, we promise clarity. Now let's put what you've learned into practice. If you want to understand how the Stoics trained emotional control, their techniques for making clear-headed decisions, and how to apply them in business, watch the video on the left. If you're not sure whether investing or saving is the right move for growing your money, watch the video on the right. And if you want to understand why seed capital matters so much, watch the next video. Let us know in the comments, were you already considering these factors when investing? Do you have a clear goal for your investments?